Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, American technology giant Nvidia Corp will invest up to $100 billion in OpenAI to finance new data centers and artificial intelligence infrastructure, marking one of the largest commitments yet in the global race to build computing power for next-generation AI tools like ChatGPT. The two companies announced yesterday, that they had signed a letter of intent for the strategic partnership, which will help OpenAI construct facilities with up to 10 gigawatts of power. To put that in perspective, that is enough capacity to match the peak electricity demand of New York City. Behold the might of American capitalism. Those data centers will be outfitted with millions of Nvidia's advanced chips to train and deploy AI models at unprecedented scale. The investment will be staged, starting with an initial $10 billion in cash, with Nvidia receiving equity in OpenAI. Additional funding will be released as each gigawatt of computing power comes online. Investors welcomed the move, lifting Nvidia's shares almost 4% in New York trading yesterday. The stock has gained about 37% this year, cementing its position as the world's most valuable company, sitting at about $4.4 trillion, which, by the way, is more than the entire GDP of Japan. Once again, behold the might of American capitalism. OpenAI, meanwhile, is the globe's most highly valued startup, with a potential $500 billion, that is $500 billion valuation, under discussion. Chief Executive Officer Jensen Huang called the deal, quote, "the next leap forward," end quote, a sign of the enormous scope of the project. According to Huang, it could involve as many as 5 million Nvidia chips, equivalent to the company's total annual shipments. Analysts estimate each gigawatt of capacity could translate into tens of billions of dollars in Nvidia hardware sales, making the revenue impact larger than the investment itself. For OpenAI, the agreement secures access to critical computing resources that have constrained product rollouts in the past. CEO Sam Altman emphasized that, quote, "everything starts with compute," end quote, arguing that infrastructure will be the foundation for future economic growth. The company, whose ChatGPT is used by roughly 700 million people weekly, plans to launch several compute-intensive products in the coming weeks. The deal also highlights Nvidia's broader strategy of using its financial muscle to cement dominance in AI chips, while strengthening ties with US policymakers eager to expand domestic technology infrastructure. It comes on the heels of Nvidia's $5 billion investment in Intel and other global partnerships to expand AI capacity. With rivals like Microsoft, Oracle, and Meta pouring tens of billions of their own into data centers, the Nvidia OpenAI tie-up represents a watershed moment in the trillion-dollar global build-out of AI infrastructure, one that could define the future of the technology economy. Next up, we move across the Pacific to Asia. Asian equities are increasingly outshining their US counterparts, supported by a weaker dollar, cheaper valuations, and easing trade tensions that have shifted global capital flows toward the region. Analysts see the momentum as likely to continue, with supportive monetary policies and attractive relative pricing strengthening Asia's investment appeal. The MSCI Asia Pacific Index has surged 22% this year, outperforming the S&P 500 by about 8 percentage points, and on track for its best relative gain since 2017. Valuations remain compelling. The MSCI Asia gauge trades at 16 times forward earnings versus 23 times for the S&P 500. Hong Kong's Hang Seng Tech Index has jumped to a 4-year high and still trades at a discount to the Nasdaq 100. The Federal Reserve's recent rate cut, though widely expected, reinforced bearish sentiment on the dollar and opened space for Asian central banks to ease policy further. That has fueled strength in Asian currencies, with options markets showing traders paying a premium to hedge against further appreciation. Quote, "given the backdrop, we are increasing our exposure to non-US equities, including Asian equities," end quote, said Chang Huan Song, a portfolio manager at Invesco, citing both diversification and foreign currency gains as drivers. Risks remain, of course, any inflation-driven pause in Fed easing, renewed US-China frictions, which is very much foreseeable, or regional political instability could quickly sour sentiment. Still, optimism is building that Asia offers distinct opportunities. Quote, the US remains the center of gravity for AI and earnings power, but Asia's appeal spans India's domestic demand, Japan's banking sector, and select Chinese technology plays, end quote, said Charu Chanana of Saxo Markets. For now, investors see the shift as durable, anchored by global diversification and Asia's competitive edge. Next up, we have one more development to cover, but just quickly, if you want to be on top of the most up-to-date analysis on the biggest developments in the world's most important markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you'd like to support the channel financially, it is just me making these episodes every day, and I rely primarily on audience support. Buy me a coffee, link is in the description below. And finally for today, we move to Europe. Italy scored its first credit rating upgrade from Fitch Ratings since 2021, a milestone that shines a light on Prime Minister Meloni's unexpected success in steering the Eurozone's most indebted large economy toward fiscal prudence. In recent days, Fitch lifted Italy one more notch to BBB+, 3 levels above junk, with a stable outlook. The agency cited, quote, increased confidence in Italy's fiscal trajectory, underpinned by a growing record of fiscal prudence and strong commitment to meeting short and medium-term fiscal targets under the new EU fiscal framework, end quote. A more stable political environment and progress on reforms also factored into the decision. The move contrasts sharply with France, which has suffered 2 downgrades in the past week. Once considered a core safe bet, Paris is now mired in political gridlock and a worsening fiscal position, something we've been following very closely on Market Update. Italy, long derided as the euro area's weakest link, has suddenly become a relatively safe haven. Italian Finance Minister Giorgetti hailed Fitch's decision as proof that, quote, we have brought Italy back on the right path, end quote, crediting painstaking budget work by Meloni's cabinet. Indeed, investors have already rewarded Rome. The spread between Italian and German 10-year bonds has fallen below 80 basis points, a third of its level when Meloni took office in 2022. Lower borrowing costs have given the government a multi-billion euro windfall to deploy in the upcoming budget. Still, Italy's challenges remain daunting. Public debt exceeds 130% of GDP, and Fitch's assumptions rest on the government hitting strict deficit reduction goals. The upcoming budget, due before the end of the month, will test Meloni's ability to balance spending demands with fiscal restraint. The upgrade also highlights a historic reversal in European credit markets. France's borrowing costs have climbed above Italy's, a once unthinkable shift. Political turmoil in Paris, with 5 prime ministers in less than 2 years and no clear fiscal repair plan, has turned the country into the Eurozone's new fiscal flashpoint. The short-term pressures on France are acute. Political instability following last year's snap elections have left Parliament fractured. Fiscal discipline has frayed, with missed deficit targets and no credible plan for repair. Yet deeper structural issues explain why France's fiscal woes have eclipsed Italy's. The 2008 global financial crisis triggered nearly 2 decades of divergence. Rating agencies penalized Italy for high debt and weak growth, while France initially held steady. Emmanuel Macron's 2017 election was meant to cement fiscal credibility. Despite pro-business reforms and tax cuts, spending remained stubbornly high. COVID-19 and the inflation shock that followed Russia's invasion of Ukraine pushed expenditures to among the highest levels in the developed world. Italy's relative improvement is also visible in fiscal metrics. Stripping out debt service costs, its underlying budget position looks healthier, and it's poised to meet the EU's 3% deficit ceiling as early as next year. France, meanwhile, remains stuck, with chronic overspending and a tax burden exceeding half of economic output. For now, France still enjoys a larger and more dynamic economy, with GDP surpassing $3 trillion last year. But its debt burden is catching up to Italy's, and soaring interest costs are predicted to push annual servicing bills above €100 billion by 2029. For Italy, the turnaround is striking. After years of instability and investor skepticism, Meloni's government has brought a measure of credibility very rarely seen in Rome. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Tuesday, and I hope to see you for another episode tomorrow.